Yeah, give him a little thank you for the food. We had celebrate for the food. We had celebrate. So we went to Gus's because I know he likes to support local businesses, so that's very important to us here as well. So Ignatius is a business associate here at AZREIA, so he's in the accounting CPA world. So I'm going to bring him up to let you know about how he can help you out. So we provide, like, as I'm sure Jose already covered, wealth is a team sport, especially when it comes to multifamily investing. So AZREIA provides those business associates, such as accounting, insurance, attorneys, agents, property managers. So you have access to all that. These are all vetted business associates that you can trust and count on. You don't have to use them, but it's a place for you to start, okay? So I'm gonna bring Ignatius in. So come on up, buddy. I love this guy. Yeah, give him a little thank you for the food. So yeah, tell us like who you are, what you do, and maybe even the class that we got coming up. That would probably be good, helpful as well.
Oh yeah, good point. Yeah, talk about the class. All right, well, welcome everybody. Ignatius CPA. Hopefully you have enjoyed the session for today. I can only, Jose's doing a great job educating you guys. I can only tell you that multifamily is absolutely where people build wealth in this country. Any of the rich people that you know of out there, they all own apartment complexes in some way, shape, or form. They all own other pieces of real estate in some way, shape, or form. So definitely super, super powerful stuff. The most important component to me comes with the refinancing and stuff like that. So about myself, a local CPA, I do real estate investing. I do stuff for real estate investors, and I also do it myself. We also do stuff for small business owners, whether you're a doctor, a lawyer, et cetera, we can help you out. Like Mike said, we do have a class coming up here on, I want to say the date's going to be August 23rd would be the date. So if that's something that you're interested in, it's going to be a lot more in depth on real estate taxes and things to consider and think about. But today really is just kind of about just shortly, if you guys have any sort of Q&A type questions, whether you're in person or online. By the way, people who are online, you're kind of missing out. I would highly encourage you to come to these things in person. Not only would you get free food, but I have some giveaways here, and there's always some other stuff that kind of comes to these events. So think about coming in person next time would be my perspective. And also networking is key. If you're going to do multifamily, you have to have a good network first and foremost. So anyways, and I apologize, I shouldn't have ordered spicy food when I was coming up. So I'm sweating a little bit because I don't do spicy very much, so you gotta pardon me. But yeah, so I mean with that, any questions anybody has, by all means. I know I got one already, so I'll go ahead and answer his real quick. It's probably the most common one that I get is entity formation, okay? Which, believe it or not, is actually more of a legal question. But it does have some tax implications as well. Okay, so let's talk through that a little bit. 99% of real estate investments are going to be inside of an LLC. You're not going to use a corporation, okay? Main reason being is the inflexibility of corporations, okay? And also some of the tax consequences of corporations. If your corporation is really only two things you could be, a C corporation and an S corporation. Both of those are bad consequences from a real estate investing standpoint. So 99% of real estate investments are going to be through LLCs, unless you're some big public company or REIT, in which case you're going to use a corporation when you have public investors like that. Okay. He also asked, I guess, when do you need to get one? Before you purchase a property. No real estate should be owned for rental purposes outside of an LLC, is my opinion. There's too much liability, and it's so easy to get them set up no matter what state you live in, especially in Arizona. It's like an $85 fee, and probably pay an attorney $400, $500. AZREIA has a good connection for what, $385? Gets the whole thing set up, I think, for an LLC through Focus Law. So have an LLC for all real estate investments that are going to be rentals. For flippers, same thing, because the LLC gives the opportunity to become S corporation. So before you buy a property, have an LLC in place. Okay. Other questions? Did I answer your questions, sir? I forgot your name. Sorry. Okay.
How do you pay yourself inside of an LLC?
How do you pay yourself? So it depends on if you're an owner. If you're an owner, you cannot take a salary inside of an LLC that's taxed as a partnership. Now, technically, LLCs can be taxed as corporations, but we usually don't make that election for real estate investments. So an LLC that's taxed as a partnership, you're going to basically take draws, or you can do what's called a guaranteed payment. Okay, just depends on how the LLC is set up. Additionally, if you're doing multifamily syndications, you're usually going to have some funds sent to another entity that you own through like a 1099 situation, essentially. Okay, so that's usually how you're going to get paid, as like a general partner that's doing some stuff inside the LLC syndication. Okay, but you don't get a W-2. Does that answer your question?
Yes.
All right. Yes.
I've heard like short-term rental, you can claim that as a active investor or active, and there's tax deduction with that. Is it recommended to take that, or is there like some drawback?
So what you're talking about is the short-term. He said for a short-term rental person, you can claim like active income or take losses. Basically, is what you're trying to get at. Okay. So yes, it's possible. There's various rules to get there. First rule is you have to have your average customer stay being 7 days or less. Okay, so if that's the case, like you're using Airbnb, VRBO, one of those sites to get people that are staying 7 days or less, then absolutely, you can do the short-term rental exception. It really only matters though for the first year typically, as you're buying the property, getting it, all the furniture in there and everything, because you're gonna have losses that first year typically. But after that, usually the short-term rentals are pretty profitable. So it's not really as big of a concern that second year. But yeah, it's absolutely possible. And I think I actually did a video through AZREIA that goes more into details on how that works and how you can do that. So definitely take a look at that. Also, I have a YouTube channel that has a ton of stuff on there about some of these strategies. So
that was on the podcast, right?
Podcast, yes. Yeah. So what else?
Would you mind later, you can put your info on the board and the podcast or your channel also, if you don't mind?
Absolutely. Yes, I will definitely write that down before I leave, for sure. Any other questions?
So you have questions. So you do accounting.
Yep.
And the restaurant?
I'm sorry?
The food, do you sponsor the food too, or?
Yeah, I sponsor the food.
Oh, okay, for some reason I thought it was your restaurant too.
Oh, no. Yeah. I don't believe in investing in restaurants, to be perfectly honest. I think they're usually a bad investment. Yeah, the only thing I would ever do food related is desserts, like ice cream, donuts, stuff like that. So, why? Because it's high margins and you don't need a lot of space. So, that's why I would do that, but yeah.
So you mentioned the idea of having an entity and then paying yourself through the entity and having it take a deduction, and I know some people, I think, use trusts to do this also, or at what point in time, what's the hurdle? Where do I need to be in order for me to start considering this as the way to go tax strategy-wise?
When do you want to put a trust in your picture?
When do I want to start taking draws from when do I want everything to go into my trust so I can take not distributions, or I can take, whatever it is. I don't know, whatever the technical, the best term is. Is it a distribution? Is it a salary? Is it a loan against this? At what point in time do I want to start thinking about developing this, what I consider to be wildly complicated structure?
So a trust, there's two types of trust basically. You got a revocable trust and you got an irrevocable trust. Most people who have a trust have a revocable trust, okay? What that means is you can change it, it can mold with you, you can add stuff to it, etc. It's pretty flexible. And from a tax code standpoint, the revocable trust is disregarded as a separate entity, okay? So it pays no taxes. You pay taxes at your ordinary rate. So to answer your question, from a revocable trust standpoint, it's good to have one involved in your picture from the very beginning, as far as I'm concerned. So if you own real estate, you should probably have some sort of trust in that picture as your top owner of all your entities, business entities, your real estate entities, etc. Because that trust is going to help make sure, the whole point of a trust is to avoid probate upon your death, okay? So just from an estate planning perspective, which is a whole nother ball of wax that we can get into, we won't because it's a long conversation, but from a estate planning perspective, you want to have a revocable living trust own all your assets. That way it's very clear if something happens to you what you want to have happen to those assets. Now, if you're talking more about an irrevocable trust, usually I wouldn't get into something like that until you have millions of dollars of assets. It's typically where you start looking at that, because those can cost thousands of dollars to maintain and also make sure you're not paying some ridiculous tax rates. So usually don't go down the irrevocable trust route when you're kind of starting out until you have, I'd say, at least a net worth of about $10 million.
Awesome. That's what.
Okay. Yeah.
So I actually had an investor call me about this.
Yeah.
I've had my rentals in LLCs typically, and I have an LLC bank account, so I get the rent paid to the LLC account. And then I'll take money out of that and transfer it to my account or whatever. I'm supposed to do that or not, or how you're supposed to do withdrawals, but that's how I've been doing it for the last 20 years. I had a client yesterday, they call and ask about, they want to do it in a trust, and I wasn't sure, is it better to hold the property in a trust or LLC? It can't be done both ways, right? Or can it?
It can be done. Do you have investors?
So they it's a rental property they have, and they're looking to buy another one, and they want to.
Do they own it 100%?
Is in their current name, and they want to switch over to a trust or an LLC.
So we've got rental property owned 100% by this person, is what you're saying, right?
Yes.
So typically, I'm going to want an LLC to own the actual property directly, and your trust is going to own the LLC. That's the proper structure. You usually don't want to have a rental property owned directly by a trust, because there's other assets inside your trust, there should be, and so you don't want, if something happens for all your other assets inside that trust to be affected.
So the title should be held in the LLC, bank account the LLC, but above that, the umbrella, the trust owns the LLC. So the LLC is part of it.
Yeah.
What about if you don't have a trust and you do a beneficiary deed? Do you still have to? Doesn't a beneficiary deed from like an LLC goes to a kid? Let's say that that has to go to a kid. Is that a way to avoid paying capital gains for a beneficiary deed as well?
Whether you have a trust or a beneficiary deed doesn't matter. There's still a step up on basis upon the death of the owner of the property, as long as there are not, whether estate tax exemption, there's no taxes due upon that death. Now, if it continues to increase in value before the beneficiary sells it, they'll have to pay capital gains on the portion from the date of death through the date of sale.
What is the
Any
cap
additional gain?
that you can pay?
Sorry?
What is the cap that you can inherit without paying tax?
Right now, an individual can give away $12 million roughly. It might be closer to $13 million for a lifetime exemption. Yeah, but that goes back. Careful to consider this, and this, not to get political, but this has to do with your voting, right? So it's set to go back to about $6 million come 2025, or 2026, excuse me. So unless it gets extended, which is not going to happen based on our current political landscape. Okay, so yeah, I mean, unless you got, that's why I say, like, that's why we're talking about irrevocable trust. That's usually kind of when you're going to start to consider that kind of stuff, like when you're above your estate tax exemption. And so if you're married, it's double. So it's 24 million right now, goes back down to about 12 million if you're married. In terms
That's
of
money that you
assets.
can inherit without having to pay taxes.
No. That's money that the owner of the property, when they die in their estate, does not have to pay any estate taxes. Okay? As long as they haven't eaten into that by giving away gifts during their lifetime. Okay? Because it's a combined limit, gifts and estate taxes.
We got time for one more question before we keep going for a few minutes. Anyone else?
Yes, sir.
Directed IRAs,
Oh, my favorite. See, I was waiting for the question. I have this shirt on here. Nobody asked the question about self-directed IRAs. Go ahead, my man.
Yeah, I just set one up just to just move it on here. How do you then go about buying, selling, getting involved in real estate with yourself?
So specifically a self-directed IRA, it depends on what type of investment you're doing, okay? So if you're doing your own property, where you're gonna have payments that you're making, expenses, stuff like that, then you're gonna wanna have your own IRA LLC on the property. That way you have full control over that bank account and can easily make those transactions, okay? If you're investing into a syndication or some sort of fund, then you can have your IRA custodian do the investment directly without setting up an IRA LLC. So it just depends on what you're trying to do within that IRA would determine how you're gonna structure that, okay? And that's the same thing for solo 401k, by the way. The only difference with the solo 401k is technically you don't have to have LLC involved because you have full control over that solo 401k. However, as we talked about with the trust, it's good to have that extra layer of protection in between your other 401k assets and that real estate property. So having LLC still makes sense in that case. Okay. I'll put my info on the board here so you guys can reach out to me. So I have some t-shirts over there, some free t-shirts. Unfortunately, I'm running a little bit low on the smaller sizes, so I think it's XL and above. You're welcome to take one. There's also some pins as well, if anybody wants to take one of those as well. So, and I'll be around the rest of the day if you guys have any other questions.
Cool. Awesome.
Thanks.
Please see how